Okay.
All right.
So, good evening, everyone. This is the second time we've done this presentation. We think it worked really well with it being interactive. So please feel free to ask any questions as you go through it. It's a small crowd, so we think we can make it relevant. So it'll be, I think, much more interesting. Not that tax isn't interesting, but it should be a lot more interesting if we can make it really relatable to you. And we'll try to give some examples as we go through it, but please feel free to share whatever your thoughts are as we go through it. So I'm going to start with just saying that we're going to talk about essential business and tax issues for small businesses. It's very difficult, as you'll see on the next slide, for us to give any individual advice to people. So we're going to put this big disclaimer out there. If you do have any follow-up questions, we'd be happy to try to answer them, but it's very difficult for us to give any sort of tax advice in a little tunnel, right? So we'll do our best to at least give you the overview. So before we get started and sort of introduce ourselves, by a show of hands, we just sort of wanted to see where people are. If you're an employee and you sort of do this, you're just looking at types of businesses, raise your hand. If you are a sole proprietor, and this goes through on your Schedule C, okay. Small business owner where you're doing like an LLC or an LLP. Okay, we got a little bit of everything so far, so this is great. And then other, if anybody has like a joint venture or something like that. Okay, and then one of them is I don't know, right? So we are AAF CPAs. The people on the phone today or on the Zoom call is Julie Chevalier, who's the partner in charge of the tax department. We also have Stacy Field, who is a director in our group, and she specializes in the small business space. And then I'm the partner in charge of what we call our Managed Accounting Solutions Group, which is our client accounting and advisory practice. So we also do the outsourced accounting and at 990 for the Boston Club. And I've been a long time member of the Boston Club. I don't even know how many years on and off, probably close to 25. I do things by thinking about how old my kids were when I did things. So I think I was probably been at least over 20 years. So in and out. So really happy to be here. And as I said, we're just going to give an overview, but I'm happy to answer any questions. Please feel free to raise your hand or just take yourself off mute if you have any questions. So with that, I'm going to pass it over to Stacy. We asked you what type of organizational structure you were to start things off. And I think that's really where it's important for you when you're starting a business to think about, what should I be? Should I be, different types of entities, which Stacy will get into. We do have attorneys on staff that can help with that, but I'm sure many of you have lawyers that you work with, CPAs that you work with. So I think it's really important to start with that. So I'm going to pass it over to our in-house expert, Stacy.
Thank you, Janice. I appreciate it. If for any reason someone can't hear me well, just let me know and I'll try my best to speak up. I have quite a little sore throat today, but I think we can make this work. So the slide that we see right here is just really our agenda for today. But as Janice mentioned, we're really open to hear any questions that you have in this group that you want to, or topics you want us to kind of discuss. We certainly will if we can. So the first thing, we talk about organizational structures, what that means for the type of tax that you'll be having in those entity structures, the importance of your record keeping, the different types of tax compliance that you'll have, excuse me, and then other things that we might have that we want to talk to you about, or vice versa. If you have questions, it's going to be an open dialogue. I like that. It's a nice knit small group. So next slide, please. So first we'll talk about the organizational structures, the different structures that you can have. And really why this is important for the tax world is because what legal structure you are really dictates how are you going to be taxed. And as you all probably know, tax law isn't, just a one page, here you go, pay your tax. There's a lot of different aspects and different scenarios that you can have for that. So the first one here would be a sole proprietor. And we talked about these in the poll question. So you probably know about these in a bit based on what organizational structure you currently have. But a sole proprietor is just one single owner. It's commonly called a disregarded entity from the IRS because it's really no different than its owner. So they're kind of one and the same. This would be filed on a Schedule C on your individual return. So the individual owner pays the tax directly on all the net earnings the company has. Now, one of the common things that is always spoken about is, well, how does owners get compensated? Okay, in this type of entity structure, the owner wouldn't get compensated through a general wage per se, or through any payroll tax return filings, because again, it's not really considered an employee relationship in that manner. So you would just take, money from the company because it's already been taxed to you from the profit that the company had. Excuse me. The next three entity structures are all what's considered a pass-through entity by the IRS, which just essentially means it's a business return, but the tax is passed through onto its owner or owners. So a limited liability company or an LLC is a little bit more common than a limited liability partnership based on the state level legal rules and what you can have, and every state is different. But that the other difference for tax side of it is that a limited liability can have one owner, so one member, whereas a partnership or a limited liability partnership must have two or more. So that would be the other main difference. So if you have a limited liability company and you're a sole single member, you would really be treated no differently than a sole proprietor for tax purposes. So you'll file it on a Schedule C, and you wouldn't take a payroll or a wage. You would just receive draw out of equity. Okay. For a limited liability partnership or a partnership of any sort, the business will file on a partnership tax return, then would issue each of its members or partners a Schedule K1. And this is what reports to the members what their percentage is of the earnings the company made for the year, regardless of how much money you received in your pocket. If you're one of those members, it's really just the total percentage you are allocated from the business. Okay. So now, how do you get compensated from these type of entities, right? You would get not compensated as a wage, again, similar to the other two structures, but it would be given to you as a guaranteed payment. And that is just a tax term for partners in a partnership or a limited liability partnership, similar to wages. But they call it guaranteed payments because it doesn't go through your typical payroll tax returns, and therefore you don't pay payroll tax on those. And it gets reported on that same Schedule K1 that the other income is reported on. This income also would be subject to self-employment tax because it's not already being subject to all those payroll taxes from being on a payroll tax return. So the way the IRS is going to get that is through your individual return.
And for those who don't know, basically what that self-employment tax is, I want to give your throat a little bit of a break there, Stacey. You don't sound great. So employment tax, if you've done it before, it's really just double what you're paying typically as an employee, just to simplify, because basically what they're saying is we want to still get the employer portion and the employee portion, and you're sort of both. So, we're oversimplifying it a bit because there are some deductions you can take against it as well, but that's basically what it's saying. So I'll give Stacey a little bit of a break. I'll try to chime in when I can, even though I'm not the expert that she is.
Thank you, Janice.
And there's a hand raised while you have a break.
Yes, excellent. We can have that now if you'd like.
Yeah, Regina has a question.
Yeah, so let me put my hand down first. So going back to in terms of what you were saying, sole proprietorship or limited liability company, and this is kind of like for tax purposes when you fill out. So you're not technically an employee in terms of wages, but you're still an employee though, right? Because if you're the only one as the owner, you're also an employee, correct?
No,
Not
employee-
necessarily.
Yeah,
I'm
employee
sorry.
is a tax definition. So, you can be working on the business. And
Mhm.
so if your definition of an employee is somebody working on the business, then yes, you can certainly be working on the business. But the IRS has a definition of employee, which is someone who follows certain IRS rules, regulations. They get taxed as an employee. There's an employer-employee relationship. There's taxes paid on both. So yeah, it depends definitionally how you're thinking of it. But if you just mean you're working on the business and you're doing that, absolutely. Does that answer your question or?
Yes and no. So when you're filling out the Schedule C, it says, or somewhere, I forget which one, it asks if there are any employees. So to me, if you're working
That's a
on the
zero.
business, that
That's
is
a
a zero.
Zero.
Okay.
Yeah.
Just
That-
wanted to
I
make
think-
sure.
Great.
that-
Well,
that-
another,
But in my C corporation, I was an employee of my own
Stop the
company.
secret. Don't you start jumping ahead, Nancy.
we'll get to that one.
Sorry.
That's okay.
But yeah, she's that star player that sits at the front of the classroom and she's always on the next slide, that Nancy. But
Excellent.
the answer to that is no. And basically what they're looking for, Regina, is to see if you should be subject to employer and employee taxes when they ask you that. So by you saying no, you're saying no, there's no employees. It's just an owner relationship
Okay.
for that type of entity.
Right. And I could give you another example, I guess,
Yeah.
of that is that you can be a sole owner company and have employees, but yet not work for the business yourself. You can be just investing in this business because you create it, you own it, but you're not doing anything because you've hired someone to do the work. You're not, just because you own the company and it's on your Schedule C doesn't mean you necessarily have to be working for it either. So you could be showing wages, and how many number of employees you have right on the Schedule C, and it never includes you.
Right.
The
Because it
owner.
always says, have you materially participated in this, for X number of
Yeah.
time? So,
So is that,
because I never know how to answer that, because my thought is, well, if I materially participated like 100%, then wouldn't that make me an employee? You know what I mean? So, and I never asked that question to actually really clarify, like our like my definition versus what the IRS definition
yeah.
is.
So the IRS definition, and they have.
Oh, you're on mute.
Stacey went mute.
I accidentally pressed my space bar. Apparently that mutes. So when you talk with your hands, be away from your keyboard. So the IRS also has definitions for material participation. And so be careful there as well. But they're pretty much just wanting to know whether you're just passive or active. So think of it as, someone who's investing in something versus someone who's actively working in the business. That's kind of where they're trying to get at with material participation.
So that would be, but that still would be a yes, right?
Yes. So if you materially participate, meaning you have full rights of management decisions, you choose what to do, you pick your clients, I'm not sure what kind of business you're referring to, but if you're making all managerial decisions, you're doing the work, and that would definitely be a yes.
Okay. Now I know for sure, as opposed to a question mark.
Yes.
Thank you.
You're very welcome. I'm glad to have lively discussion. So the next one, we're going to jump into Nancy's topic here is S corporations, which is where I love S corporations. That's kind of where my specialty really lies in. And this type of entity structure is a corporation first, but then for tax purposes, it makes what's called in the subchapter S election, so that the way that it's taxed is not being taxed as a corporation, which we'll talk about next, but rather it gets passed through to the individual owners. And this could have one owner or multiple owners. That doesn't change the impact of how you're going to be taxed as an S corporation. And this gets, like I said, this gets passed through the individual, sorry. They also have a Schedule K1. So it's the same term they use interchangeably between the partnership and the S corp. So that will report the amount of income that the corporation had for the year, taxable income, which you'll then have to pay tax on. Okay. Now, if you are an employee, so you're actually working for the business, you are considered an employee for employment purposes, for payroll tax purposes, paying, Social Security, Medicare tax on your wages. You're required to give yourself a wage. And the IRS will go even further to say that an owner employee is actually required to give themselves what they consider a reasonable compensation, which of course they don't define what reasonable is, but you just think about what you're doing. What would you pay someone, a third party, to do that same type of work? You could argue that that would be reasonable, right? It's market value. And so this all gets reported to you as the owner in W-2 through payroll tax returns, okay? But the one thing that the IRS will now say is, even though you're an employee for payroll tax purposes and filing of a W-2, some of your employment benefits, you're not really considered to be an employee. So health insurance, life insurance, disability insurance, things like that, that companies are able to pay for their employees. And an S Corp could pay for their owner employee for these type of things. But in order for it to be deductible as an expense for the corporation, it needs to get reported on the W-2 of the owner. And so we always like to recommend that if you have both employees who are non-owners and owner employees, that you track those type of benefits separately so that it's easily managed at the end of the year to report them separately and differently on the tax returns. Okay. Excuse me. Then the next one would be C corporations. So this is where the company just pays all the tax. Right now, and for the last few years, the IRS has had a flat 21% rate, which makes some business owner thinks it's somewhat favorable because it's a lower rate than, say, the individual highest rates that you might see in some of these other pass-throughs. However, C corporations have what people say is double taxation, because if the owner then wants to take money out of the corporation, that's not tax-free. That comes to the owner as dividend income, and then you would have to pay the dividends tax on your individual return for that. Then you might think, well, if that's an expenditure for the business, wouldn't that be some kind of expense and then lower taxable income? It doesn't work that way. So it wouldn't be. It is just a reduction in equity, but it doesn't affect net income. So there's where the double tax comes in, because you're going to be paying 21% originally on that net income the company made for the year. And then you're saying, oh, I had net income, I'm going to give some out to my owners. They're going to pay tax on that again. So it's a little less favorable for that point of view. It's a little harder to strategize ways of getting money out of the corporation. And then, there's a lot of different, obviously, opportunities to do different things, but that would be the basics. Then, of course, if you work for the company, you can take yourself, you're completely an employee for all purposes, employment taxes, employment benefits, all of those such things, and you get a W-2 reported that way.
So I think you did a great job, Stacey. I'll give your throat another rest. The next slide is going to be mine. But before we head off of this slide, there's a lot of things. We've simplified it here, but there's a lot of things to take into consideration aside from the fact of the different tax rates, right? So the first 4 on here are basically going to be at your, whatever portion comes to you is going to be at your personal tax rate. C Corp is at a C Corp rate, and then depending upon whatever you get for dividends would be taxable. But there's other things to take into consideration. What is your exit strategy for the company? Are you planning on bringing in other investors? If you are bringing in other investors, do they meet the criteria of who can be an investor in that type of entity, for example, an S Corp? So there's a lot of different things to take into consideration. We focus mostly on the tax rate because that's typically, a significant driver. But you do have to look at some other pieces. For example, anything that's related to venture capital is almost always going to be a C Corp, a Delaware C Corp, based on the corporate rules that are associated with that, and what happens when you're investing in a C Corp. So there's a lot of different things to consider when you're looking at that. Tax rate is certainly a significant one. So when I go to the next slide, hold on, it's not. I'm gonna move this. I expanded my view so I could see everybody. So when you start thinking about the type of entity, we talk a little bit about record keeping. That was the second bullet that came through. And it's really important for you to do sort of a pro forma so you can see what your taxes will be, what type of entity is better for you. So that's really where my group comes in, or people like us, where you really just want to make sure you're documenting everything and keeping everything on a tax basis, also looking at your projections, looking at planning. It also helps you with business intelligence. What I mean by that is if you're doing good record keeping and allocating of certain expenses, for example, you can start to look at, gee, which ones of my services or which ones of my products are the most profitable, or, you know, anything like that. Any sort of business intelligence that you want to get from your financial statements is really helpful from a record keeping perspective. It also helps you to worry about, you know, your business. You're not worrying about cash coming in the door. So for example, you know, I'll have a client that will say to me, I never know if I'm doing okay from a cash perspective. I see money in my bank account, but I'm not really sure, you know, what's coming up in the next month, you know, and so they worry about that. So we really help to kind of do, or, you know, you can do it yourselves in Excel or whatever, but to help do a cash flow projection. Who's still outstanding? Who owes you money? I get that question a lot, that our small business owners feel like they spend an awful lot of time worrying about things like that. So having good record keeping is certainly helpful. And then the first bullet on here, which is last but not least, is documentation for your tax returns. Now, we obviously have many clients who get audited, and you know, there are people out there that will hand the IRS agent the proverbial shoebox. I can just say that it's really important. We have clients that have taken a certain position, which is a legal position. But if you don't document that position, you're not going to remember in 2 years when the IRS comes a knocking. So we do like to not only document from record keeping, but what positions did you take on something? Is it an uncertain position? Is it something where you were using some judgment? Whatever it is, you really want to document that, so that when you won't panic when there's an audit. And we go through lots of audits, and you know, the ones that are the most successful are the ones where you've got really great record keeping, good documentation of your positions, and you know, you're able to restate your position. All right, the next slide. Unfortunately, we're going to go back to Stacy.
Actually, I'm going to step in and help
right.
Stacy today and save her voice a little bit.
We'll do tag teaming here. Thanks,
yes,
Julie.
Definitely. So Stacy already touched on the federal income tax compliance aspects, but there are many, many different types of taxes that a small business may be subject to. And so we just wanted to go over some of those and the topics to make sure that you're aware of them. And, you know, and obviously you should have a CPA and legal advice, you know, as already mentioned. But it's good to kind of know these things that are out there as you come across them, as your business continues to grow. So one of those is state income tax. Or multi-state tax, as we say. If you're domiciled in a state, like if you're located in Massachusetts and that's where your business was created and that's where you're doing business, then that's really your domicile or your home. But in today's world, there's been a lot of changes as far as doing business across the country or even across the world now. With the technology that we have. So states are trying to catch up and make sure that they're getting their revenue dollars, despite people working remotely, as we all know with the pandemic as well. And I'll get into that a little more too. But the states are looking historically, states would look at whether you had sales, property, or payroll in the state, and in one of those factors. And if you did, that would give you Nexus. or a filing requirement in the state. So I don't know if you've heard that term Nexus before, but that's what it means, the right for that state to make you file a tax return. And so in the past, you really had to have a physical presence. You had to be going into the state and having salespeople, travel around and actually, selling physically in the state. But now with the technology, states have passed a lot of rules. If you have a certain amount of sales, even if you never step foot in the state and you're shipping them all by FedEx, then they've come up with some rules and thresholds that you may have a filing requirement if you have a certain level of sales. So this is totally new over the last few years with the way that we do business now. So you could have not have employees working in the state physically, not have inventory in the state, and just have sales and have a filing requirement. So it's just something, they usually have thresholds. They range from like $100,000 of sales to 500,000 of sales. That's kind of like the general threshold. But in addition to regular income tax, there also could be sales and use taxes for the same rules. Having just sales into a state at a certain level could subject you to have to collect sales tax from your customers as well. So, and then also sales tax, as you know, we pay it when we purchase products. But sometimes you might go into a state that doesn't assess a sales tax when you purchase something. Like New Hampshire, that's the closest one with no sales tax. If you go into New Hampshire, you buy a piece of furniture and you bring it back to Massachusetts. New Hampshire is not going to charge you sales tax on that because they don't have sales tax in their state. But Massachusetts will assess a use tax because you're using the property in the state. And because you didn't pay a sales tax originally, Massachusetts will charge you the 6.25% as if you had bought it in the state. And this is where I see a lot of my clients have issues, because if you're a service business, you may not be subject to a sales tax because you're performing services. But you might purchase software to do your business and perform your services. And the company may not charge you sales tax for whatever reason on that software. But if the state comes in and audits you for sales and use tax, they're going to go through your entire purchase history and see if you paid sales tax on all of the things that you were supposed to. So I've had some pretty large use tax assessments for businesses that you would think sales tax doesn't apply to us whatsoever. So that's, and the state, they're looking for any way they can get revenue. So they're very aggressive with audits. I have had more sales and use tax audits over the last 2 years than I had in my probably entire career added together before that. So they're trying to get revenue. And as I go into the next type, actually there's a question.
We have a question. Yeah, go ahead. And that's why they call us Texachusetts, but go ahead.
Yes.
So if I could kind of go back to what you were talking about, you kind of touched upon it in terms of a service. I mean, obviously, if you're selling a physical goods, you you can see what's out of state and what's in state. But for a service, with everything being global, it might be, who knows where. So where does that sort of fall into? Because you started to touch upon it as far as state income tax and yet state and use tax. And this is a new ruling. So how does that affect in terms of services?
Okay. Well, there's 50 different states and 50 different rules of how they would consider, the service revenue. And I'll just give a brief example that'll help explain it. There's very high level. you either look at your services based on where it's performed or where the market is for the service. So for example, Massachusetts is a market-based. And so if you were performing the service in Massachusetts, Massachusetts would say, that's our revenue.
Okay.
If you were sitting in Rhode Island and performing a service for the Massachusetts client, Massachusetts would say, that's our revenue, because the market, the client is located in our state. However, I don't know all the state rules off the top of my head. I know Massachusetts, but I'm going to give an example. It could be wrong. But Rhode Island, if they're a performance-based state, in that example, where the work is performed, Rhode Island would say, that's our revenue also. So you would actually potentially be double taxed on that particular revenue. Rhode Island would say it's ours, Mass would say it's theirs, and you would actually have to pay tax to both states on that
Okay,
revenue.
how can we fight that? The double tax?
Unfortunately, no. But if you're doing business in enough states, or if you realize that, if you're working with your CPA, maybe it's an employee that for their convenience is there, but, and you know, it's not good for your, you know, your overall tax position for someone to be there. You might not allow your employee to be there and do the work from there. So you just, there's all sorts of rules, and you could require them to come into the office in Mass, you know, where you wouldn't subject you to Rhode Island taxes otherwise. So there's all kinds of strategies that we, you know, talk through when it comes to state taxes. And it also depends on how many states.
Yeah, so you basically said if the work is performed in Massachusetts, it's Massachusetts tax, regardless of where, say, the company may be, like say if, like you had mentioned, the companies in Rhode Island, but all the work is done in Massachusetts, then that would just be a Massachusetts tax versus a Massachusetts and a Rhode Island tax, right?
Yeah, I didn't get your example exactly.
So
but
I think if I understood it correctly, I think she was saying it's present based, but it's market based. So you might want to repeat that.
Yeah, well, I'll just give you the opposite example. If you were in Massachusetts doing, performing a service, but your customer is in Rhode Island, Massachusetts would say that's Rhode Island revenue because your client's not located here. But if you, Rhode Island would also say that's not our revenue because the work's not being performed in the state. So that would result in no one taxing it. But there's, I'm way oversimplifying it because there's all sorts of rules when you have a nowhere sale, and it's very complicated. So I won't get into those rules today.
And when did this rule take into effect in terms of this new ruling?
What these rules are called is economic nexus rather than physical presence nexus. So these rules started going into place with various states probably within the last 10 years. And so states have been jumping on board. Now, what you may have heard about most recently over the last few years is the Wayfair case. I don't know if you've heard that. That all had to do with sales and use tax. But economic nexus for state income tax has been around for 10 years, and just states have gotten on board over time to those rules. But the Wayfair case, which addressed economic nexus for sales and use tax, was just about four years ago or so. And all the states basically have come up with economic nexus rules now for sales.
Okay, so everyone's looking to get more money. Basically.
That's basically the bottom line. It's how are states getting their revenue, and they're able, but with these new economic nexus rules, it's favorable for the state because they are taxing out-of-state taxpayers and not, their in-state people. So they can encourage people to come and do business there, but get their tax revenue from outside the state. So that's ideal for any state.
So does that also hold true for, like, companies have, satellite offices and everything else? So does a rule apply that it's only the headquarters, or does that rule apply to all satellites?
All satellites, wherever you have people or property that can
I mean, as far
create.
as service, not necessarily, people.
But
or
even
property.
services, if you've got people physically performing services in other states, then they're physically there. So physical nexus trumps economic nexus always. If you physically have someone in a state, typically you now have nexus or a filing requirement.
Now, I know we could probably talk about state and local taxes.
That's my
forever.
specialty.
I think, yeah, it's your specialty. We want to move on because we're only tipping the iceberg here. But just know that it's super complicated. Particularly, we're just saying here sales and use tax, but the acronym that we use in-house is state and local tax, SALT. So there are even some jurisdictions within a state that will tax you. There are some city taxes. Could depend on the zip code that you're working in. There's water taxes. There's all sorts of other taxes. But this is a whole area of specialty. Just know that it's a risk area. If you are ever going through due diligence, it's one of the top areas that people look at to try to identify what that exposure is. There are people that say, I'm going to run my business. I'm not going to run my business based on taxability, but there is a risk on that. So with that, I think we better move on since we're running
I'm going to go
low on
quickly.
time, and it's a topic all amongst itself. So
I just wanted to know,
Thank you,
someone
Janice.
did have their hand up. So if you wanted to email your question, or if we have time at the end, please remember your question.
I'll write it in chat.
Great.
All right, I'll try to zip through. Sorry, state and local taxes is my specialty. I obviously have a passion for it, and I could talk all day about it. So I'll try to move on to the other types. Payroll taxes, we touched on this on the first slide. I just wanted to point out on this piece that it's where the employee is working. So if now that the pandemic is over and the state of emergency has been released, then now if you have people that continue to work remotely from other states, you might have issues, with withholding those specific states' taxes and filing payroll returns in those states. So just something to be aware of. The employee versus contractor. So the payroll is a W-2 employee. For 1099, that's an independent contractor. And you typically need to provide an independent contractor a 1099 if you pay them over $600 over the course of the year. So it could be multiple small payments that add up to 600 or more, and you have to provide them a 1099. And typically you would give the independent contractor a W-9 form, similar to the W-4 form that you fill out for withholding for personally as an employee. You would give them a W-9 form, which would give you the information for their social security number or their employer identification number, what type of entity they are, because you don't have to give a 1099 to a corporation, only to unincorporated entities. So that form would tell you exactly what type of entity they are, so you know whether to provide that or not. And then also, it's not just for services performed. You might also have to give a 1099 if for rental income or legal expenses as well. And Stacy, correct me if I'm wrong, for legal, it doesn't have to be, it can be a corporation may be required to receive one for legal. Is that correct?
Legal has some special rules around it as well, yes.
Yes, okay, thank you. And so you have to be careful when you're hiring someone, whether you would classify them as an employee versus an independent contractor. There are federal, the Department of Labor has federal rules associated with that, but just so you're aware, Massachusetts rules are much more strict than the federal rules. So basically, you need to look at what they're doing, how they're doing their work, if you're directing it, or they're able to decide when they do it, how they do it. So there's all sorts of rules, but you definitely want to look at that, because if you classify an independent, someone as an independent contractor and they should have been an employee, there's lots of penalties you may have to pay on payroll taxes that weren't paid in, unemployment taxes as well. So just something to be very careful of on classifying someone. The next thing is property taxes. This could be city or town level tax that you pay on the property, tangible property that you have. So that could be equipment, machinery. It could be copy machines like office equipment. And you typically file an annual information return. In Massachusetts, that's typically due March 1st. And it's important that you file that, because if you don't file the information return, they will assess you based on whatever they decide, and you're unable to appeal that decision if you haven't filed the initial. So that's something you want to be careful of as well. And the last type of compliance I just want to make you aware of is unclaimed property. And this is typically, it's only at the state level. And you typically think of like payroll checks that haven't been cashed. I mean, that's historically what would have been unclaimed property. And the states typically have a website, and you can search your name, your business name. You could do that now to see if you have any money owed to you. But if you're a business and you have any outstanding checks, which is rare with direct deposit these days, but it also applies to credits on account. So someone may have made a deposit to you and forgotten about it, never followed through on the contract. Technically, that's a credit on account that's owed back to them. It's not your money. And or credits on accounts receivable. Maybe they overpaid what they owed you, and now there's a credit sitting on there. So you're required that if they don't, it depends on the state, on the time period, but if they don't collect that or use it within a certain amount of time, you're required to report and remit that amount to the state so that they can report it and get it back to the proper person or business.
Julie, you want to take Elaine's question now?
Yes.
She has a question in the chat. It says, I did a project for a Connecticut company, but did all the work from Massachusetts. Do I need to pay tax on the Connecticut earnings?
Yeah, I want to separate out income tax from sales and use tax. That's there's not enough information here to really answer it, because there's income tax that you definitely will be paying on it. Is your question, should I have collected and remitted sales and use tax on it? Because you definitely have to pay income on it from an income perspective.
Well, it depends on if you, so you need a lot more facts to be able to do it, because
this is where we said we can't give individual.
you may or may not have to in this case, but it's something I would definitely run by your CPA when you're doing your return.
Mhm.
Yeah, and I just want to make sure that when we were talking before about the multi-state, it's about the sales and use tax as opposed to income tax. So it's a little bit confusing, I know.
Well, and income tax, yeah, I mean, even it depends on, again, you go back to what kind of entity structure, if you're performing a service, like there's a lot to look at to decide, did you travel there at all? So there's many, many questions that would, be required to be answered to come up with a final answer for you there.
Mhm. Okay.
And like Julie mentioned earlier, there's also thresholds that every state is different. So, you know, if it was such a small percentage of your total, that might be a different answer as well, from your total annual sales from all customers, all states.
Correct.
Okay, so
Next
now
slide.
we're just
Stacy.
talking, now we know that there's all sorts of taxes, and as Nancy mentioned, we're from Massachusetts. We're not the only state that taxes, but you know, as I said, it's tough here in Massachusetts and in other states. So what can we do about it? Are there any strategies or anything that we can do to try to mitigate? And I'll leave that to who? Stacy, are you?
Yeah, I'll come back for this here. So one of the things that are more commonly used for tax saving strategies for small businesses is deferred compensation. And so we don't mean deferred compensation as in a complex C Corp world with stock. We're more thinking of in the eyes of retirement strategies and saving options. So small businesses have a lot of different options for the type of retirement savings that they could do. And generally speaking, if you're a small business, you may have only yourself as an employee, so-called working for the company. You can have, or just a few, you know, for example. And there's a lot of different types of retirement savings account that you can have. And these, excuse me, retirement plans all would have a tax savings component to it, because you would have this expense that the company's now giving out to you as your savings for retirement, and then get a tax deduction for that. Generally speaking, the person receiving the retirement funds in their name now, so the employee, would likely not be paying tax on that income yet either, because in most cases there are deferred plans. So you don't have to take the money out. Don't have to get taxed on that money until you take it out during retirement. And so sometimes you might think you might be a booming business now. You're bringing in as much as your income that over your span of your lifetime now at the stage of your life you are now. So you want to get a tax deduction now and pay tax later, when hopefully you may be in a lower tax bracket because the only money you may be bringing in is retirement money. So that's one thought about it, that it could potentially be a tax savings, but of course that is never truly known because tax rates change all the time, and we're even hearing now that rates may or may not go up, and so so that's not what you're banking on per se. It's more of a deferral. So you're not paying it now, you'll be paying it later when you've received the retirement funds. So like I said, there's a lot of different plans, and the type of plan you might want to use or have in your business will also depend on what kind of structure you are, whether or not you have employees or not. So some of these plans are IRAs. So you have your traditional IRAs, the most common that people know about. You have your Roth IRAs. And then you have plans that employers could have. So you could have a SEP IRA, which is a self-employment IRA, so someone who's self-employed. So that would be your Schedule C or your single member LLC, things like that. Anyone who has self-employment income that they're reporting on their return. And then there are simple IRAs. So again, that's a business plan, but it's the same form of structure of plan. It's an IRA, but one that employers pay out. Each plan has different thresholds of what's the maximum amount that an employer can contribute to this type of plan. So you want to look at that too, to see if you're just trying to maximize yourself or whether or not you are just trying to max the biggest deduction you could possibly have, different things like that you want to take in consideration. There are 401ks. There's profit sharing plans, which is defined contribution plan. And then you have defined benefit plans, which is another bucket as well. The IRS has limits, like I said, on how much you can contribute per year. In 2021, that's $58,000 per person per year on your defined contribution plans. But again, depending on what plan you have, could be different, because IRAs, for example, has a much lower rate. 401ks have a deferral max that you can do as well versus an employer portion. So there's a lot of rules around this. The IRS also requires certain information and tax returns to be filed for retirement plans once they've met a certain limit. That tax form is called a 5500. So you may have to file one of those depending on the type of plan that you have and whether you have employees. The IRS isn't the one that dictates a lot of the specific rules on your employer plans. That's where your Department of Labor, and depending on what state you are, which is going to dictate a lot of that, because they're really in place to protect the employees. Okay, so they want to make sure that there are no non-discrimination rules amongst the plan, that there's proper eligibility requirements, for someone to enter the plan, and that you've met those guidelines. And so if you have an employer plan, ends up being a little more cumbersome than, say, a single, owner's plan, because then you have all these other requirements that you need to follow and meet. There's also strict guidelines of when contributions are required to be made. So the IRS actually states if you want to have a tax deduction for your retirement disbursement out, that it needs to get deposited into the retirement plan given a certain date. And again, generally it's when you file your tax return, but that's not amongst all different plans. So it depends on really on the plan. If you have employees, any of their deferral amounts need to get deposited based on the Department of Labor's guidelines, which is as soon as feasibly possible. Because again, it's not your money, it's deferral coming in from your employees. It's their money. You need to remit it into.
And I do think many of our clients have gotten into trouble on that with the 401k contributions. So I always say, try to use your payroll company or someone that can automatically deposit them, just to avoid that liability and compliance issue.
Exactly. And I've had a self-employed Schedule C client where they have a simple IRA, and it has similar rules to a 401k, where again, the deferrals that come out from employees need to get deposited pretty much, as soon as possible. So they have a payroll person for that. But then their own salary per se isn't going through their payroll company, right? Because they're not an employee. They get a draw, but yet they're contributing into the simple IRA. So they're like, okay, well, what piece is my employee piece? What piece is my employer piece? And when do those need to get deposited? And that's where it gets a little tricky as well. So in that specific scenario, they would need to deposit it in by January 31st of the following tax year. So you've earned all your, she took draws out of her company throughout the year, but her deferral piece, so the maximum, she always wants to do the max. So she wants to put in her max. That deferral piece needs to get deposited by that January 31st. So she had kind of a mistake that year because she thought it was, when I file my return, I'm going to pay in my amount of mine into my retirement plan. But that's the employer piece that has that deadline. So that's why I just wanted to note the being careful on the different plans that you have, and whether it's employee versus employer contributions, then deferrals and not deferrals. So yeah, that's very high level on retirement plans. And Janice, you're on mute. I can see that you're saying something.
I was saying I have a hard stop at 6, so I'm going to have to stop sharing. But I just want to thank everybody for joining us. If there's any last minute questions, great. I also wanted to provide this last slide where it has all of our contact information if there's any follow-up. And I apologize that I have a very hard stop, but another call to do at 6 o'clock.
Thank you, Janice. Thank you so much.
Thank you all for joining.
Thank you, Stacy. Thank you, Julie. Janice,
you for having us.
You can drop off. I just want to tell people that, the series, the Women in Business series, will be continuing. We're going to have Ask a Lawyer coming up in December. We have insurance employee benefits coming up in January. We have how to incorporate DEI into your business, and we'll do that in February and March. And then we have a panel in April and May, talking about stages of business development and experience. And then we're ending in June with a cheese and chocolate fun time. And also the woman who owns that company will be telling her story. So the Women in Business series will go throughout the year, and I hope everybody enjoyed today and comes to all of the rest of our series over the next few months. So thank you, everyone. This is the smart crowd. Nobody wants to hear about taxes. So, you know, we give ourselves, anyone who's here tonight, you should give yourself a big pat in the back that you came, you listened, and everyone needs to know this stuff, unfortunately.
Thank you
right.
for
Very
having
much.
us.
Thank you. Have a great night.
Thank
You
you,
as well.
everybody.
Thank
You're
you.
welcome.
Bye-bye.
Bye.
Thank you.
Bye.